Let's talk about the top 5 unique tax saving strategies for your investments to achieve financial independence. Please keep in mind that I'm not a CPA or a tax attorney, and none of what I'm about to talk about is any specific tax advice. The tax saving strategy is a big part of our FIRE journey and my financial coaching business, and you can check out these videos about our early retirement strategy with minimal taxes, and I will put those links in the description below. But first, I want to thank every one of you subscribers because you made it possible for my YouTube channel to get monetized, and I also got monetized with TikTok at the same time with over 16,000 followers. So thank you, and I will continue to put out educational content on Fireside Chat to help you achieve financial independence and retire early. Tip number 1 is tax loss harvesting, which allows you to lower your tax bill by offsetting capital gains with capital losses. This is a pretty common strategy in the investing world, and you can use it to reallocate your portfolio as well by selling certain stocks that overperformed and selling stocks that underperformed. If you're brand new to the investing world, make sure you divide your gains between short-term capital gains and long-term capital gains. If you held your assets for under a year, then you'll be taxed as ordinary income tax. If you held your assets for over a year, then you're taxed at the capital gains tax rate. For example, let's say you made $10,000 in gains in this one stock you sold for the year. You lost $15,000 in another stock that you sold, and you held both stocks for less than a year. The $5,000 you lost total can offset $3,000 of your ordinary income. The remaining $2,000 will carry forward to offset income in future tax years. Let's say you're in the 24% tax bracket, and then you'll just multiply $3,000 by 24%, and that's $720. So not only did I save 24% of the $10,000 gains I made from the stock at $2,400 by offsetting the loss from the stock, but I also saved $720 by reducing my ordinary income tax by $3,000. This strategy could save you even more money if you're in a high income tax bracket at 32%, 35%, or 37% marginal tax rate. If you sell another stock with capital gains in the following year, you could apply the remaining $2,000 of your capital loss from this stock to that gain in the following tax year. But keep in mind that this strategy doesn't apply to your tax deferred accounts like 401k or IRA. This strategy applies to my taxable brokerage account. Another thing to keep in mind is the wash sale rule, and which prevents you from selling a stock at a loss and buying the same stock within 30 days of the sale. By the way, you can get all of our financial independence resources by visiting firesidechat.com/contact. You can also check out the Fireside Chat shop if you're looking to start your own YouTube channel, and I have all of my equipment at firesidechat.com/shopping. Oh my God, that's gross. You ever burp and the coffee just came up? It's gross. And tip number 2 is using securities-based lines of credit, or SBLOC or SBLOC, to avoid paying capital gains taxes on your investments. It's kind of like a HELOC, but you're leveraging your investment portfolio to create a line of credit to borrow extra cash from your brokerage firm. However, I would argue that this is more of for a high net worth individual who has the cash to pay back the loan in case of a bear market when the value of your portfolio declines. Depending on the brokerage firm, you could borrow anywhere between 40 and 70% of your portfolio. You need to be very careful with how much you want to leverage, because if your portfolio suddenly drops 20, 30, or 40%, you're going to get a collateral call or maintenance call from the brokerage firm to make you repay some or all of the loan principal. If you don't have the cash or to repay the loan, then they could liquidate some of your equities in your portfolio to pay back the loan, which means you could end up selling your stocks at further losses. An SBLOC is considered a non-purpose loan, so I won't be able to use it to buy more stocks or other investments. I would need to use what's called a margin loan to buy more investments instead. Think of your SBLOC as a credit card for your investment portfolio. You could save both short and long-term capital gains taxes by borrowing against your investment asset. Please keep in mind that this is not financial advice. For example, if I had $2 million in my taxable brokerage account and I decided to use or sign an SBLOC agreement to borrow up to 50% of the value of my investment assets, which would be $1 million in my line of credit. As long as my portfolio's value doesn't drop to a certain threshold that I agree with my brokerage firm, I would just need to worry about the monthly interest repayments. If I use the SBLOC to say purchase a rental property that generates 12% in annual cash and cash return, then and my SBLOC interest rate is at 4%, I'm effectively making 8% in total return. If I use it to build my business and my net profit is 20%, then I could easily repay the loan at a 4% interest rate, right? There are obviously risks associated with the strategy, so I would need to make sure that I have enough liquidity to repay the loan at any time. Remember to never bite more than you can chew when it comes to taking out any type of loan. You need to know whom you're signing the SBLOC with, how much of your investment portfolio is leveraged, and the payment plans with the brokerage firm. This is also a part of the buy, borrow, die strategy by millionaires and billionaires, and I'll link that old video in the description below. By the way, if you need help with your personal finances, like budgeting, saving, or investing, you can schedule a free one-on-one 20-minute financial coaching session by visiting firesightchat.com/coaching. Tip number 3 is using a stepped up cost basis for your investment portfolio. And I'm going to simplify this strategy as much as possible, but this will entirely depend on your financial situation. So let's say I bought a stock for $5,000 and it gained over $10,000 over the last 2 years. And I'm currently under the 0% capital gains income threshold. So I sell that stock today with over $10,000 in profit because I realize I'm going to be in a much higher tax bracket, like 15% or 20% when you're in early retirement. Now, my cost basis is $15,000 instead of $5,000, and so effectively saving $1,500 in capital gains tax if I'm in the 15% tax bracket, or $2,000 in the 20% tax bracket. This strategy is beneficial if you're in the 0% capital gains tax bracket, and for the year 2022, your long-term capital gains tax rate for single needs to be under $41,675. For the head of household, you need to be under $55,800, and for married filing jointly, you need to be under $83,350. These numbers are adjusted by inflation every year by the IRS, so be sure to check out the IRS website at the end of every year. And remember how I talked about wash sale in tax loss harvesting? It will not apply to this scenario because I sold my stock with capital gains. The wash sale rule only applies to capital losses. So I could sell the stock for $10,000 in profit today and then immediately buy back the stock that I just sold. This strategy can be complicated if you don't have a tax strategy with your overall finances. Please get with a CPA or financial advisor if you want to step up your cost basis to save money on capital gains taxes. Tip number 4 is donating your stock to charity to save money on capital gains taxes. When I decide to sell a stock that I held for the long term with significant gains, I would consider donating some of my appreciated shares to a donor advised account to reset my cost basis at the current price. So donating some shares of the stock you're selling instead of cash can be much more tax efficient. Let me give you an example. Let's say I want to buy real estate and I need to cash out $150,000 in stock that will trigger 20% in long-term capital gains tax if I combine it with my current income. That's automatically $20,000 in long-term capital gains tax that I would need to pay, right? However, if I choose to donate $30,000 worth of shares and stock to a charity like an animal rescue group or a shelter, then donating the proceeds would trigger a higher tax deduction. So not only did the stock donation benefit me by saving capital gains tax, but it also benefits the donor recipients like the animal shelters, right? It's far cheaper to donate in stock than cash to reduce future capital gains taxes. You just need to make sure you understand the IRS limitations on deductions for donations of appreciated stock. And tip number 5 is contributing to your health savings account or HSA. Not only does it reduce your taxable income, but you can actually invest your contribution inside your HSA tax-free. And what that means is that you won't need to report dividend income or capital appreciations inside your HSA. My wife and I prioritize our HSA over Roth IRA on our FIRE journey because of the triple tax advantages, and let me explain how this works. For the year 2022, you can contribute up to $3,650 for individuals and $7,300 for the family plan. And for 2023, you can contribute up to $3,850 for individuals and $7,750 for the family plan. If our marginal tax rate is at 24%, making $250,000 a year in gross income, then we could save an additional $2,000 a year in taxable income on top of the $7,300 family plan. Any interest or earnings I earn in my HSA is not taxable. If I had $10,000 invested in the HSA investment account with a real estate investment trust that pays a 4% annual dividend yield, that $400 annual dividend payout is not taxable. If I decide to sell a mutual fund inside the HSA and buy another mutual fund, the profit gains I made from the sale do not trigger a taxable event. And I strongly encourage you to watch this video about the differences between FSA and HSA. And if you want to know more about how to save money on taxes during your early retirement, be sure to check out these two videos. So with that said, I appreciate you watching my video. Don't forget to subscribe, and I hope to see you in the next video. Have a good one.